that is to say Europe, the Far East, and North America. This has led to strong equity performance, a coordinated move higher by all major equity markets. At the same time, the leadership that was shown by the U.S. equity markets in the first part of the year faded somewhat in the third quarter. This was partly a result of the failure of the U.S. Congress to deal with a comprehensive solution to the healthcare situation and mixed reviews of the tax reform plans that are now before Congress, the fate of which, of course, is still unknown. What we saw in the U.S. and worldwide markets was a continued show of enormous strength by technology companies and growth companies in particular. This led value stocks to underperform somewhat. We also see a trend of central bank tightening. Interest rates are going up around the world. The Bank of England raised rates this week. The U.S. Federal Reserve is expected to raise rates one more time before the end of the year, and we expect to see the Bank of China raise rates as well. The slide that we call the quilt shows asset class performance for various years, and the point of this chart is very clear. It's impossible in any year to predict which particular asset will be the best performer or the worst performer. You can see that in 2016, master limited partnerships, MLPs, were the best performer with a return of 18.3%, and that developed market international stocks, EAFE, E-A-F-E, were the worst performers. In contrast, so far in 2017, MLPs are the worst performers, and EAFE is the second best. The point of this slide is that it's very crucial for every participant to have a well-diversified portfolio. Having a concentration, for example, only in the S&P 500 ignores the influence and the possible overperformance both of developed and emerging markets outside of the United States, as well as other asset classes. So the point of the quilt is you don't know what color is going to be on top, you don't know what color is going to be on the bottom. It's therefore important to own all of them at all times. Now, during the last quarter, your investment committee and your board made some tactical moves. We decided to reduce our exposure to the U.S. large capitalization stocks, the S&P 500, by 10%. Partly this was a reaction to the very significant overperformance of the heavily weighted technology stocks. We took 10% out. We put 5% back into the S&P value index. That is to say, the lower priced, less volatile stocks. And we reserved 5% in cash for what we expect to be an eventual downdraft in the S&P. So we're keeping some powder dry. It's never a mistake to take profits at some point. At the same time, we changed the asset mix in the appreciation and income fund. Previously, that fund was 60% equities, 40% fixed income. We changed that to 55% equities, 45% fixed income, again in recognition of what appears to be a fully valued equity market. We maintained one of our underperforming positions, master limited partnerships, and we maintained our overweight in emerging market equities, which has been one of the best performing classes this year. So here's the actual returns of our managed products over the rolling 12 months. You can see that the Capital Appreciation Fund has a stellar return of 17.22% over the last 12 months, good by anybody's measure. The Appreciation and Income Fund, 11.14%. The Income Focus Fund, 2.56%, a reflection of weakness in the bond market caused by tightening by the central banks, and 1.03% in the ultra-safe Capital Preservation Fund. Now, return is only one half of the equation. The other part of the equation, of course, is how much risk we're taking to generate those returns. We look at risk by measuring volatility, how much our portfolios go up and down compared to the market. And what this slide demonstrates is that each of those three portfolios is in fact less volatile than the market, which is intended to measure it. So on the left, you can see that the Capital Appreciation Fund had a standard deviation of 9.27% compared to just over 10 for the market. Similarly, the Appreciation and Income Fund and the Income Focus Fund were also below their related benchmarks in terms of volatility. So what we're trying to generate here is similar returns or better returns in the market with somewhat less risk, and we're being successful in doing that. We introduced Tier 2 funds this year so that participants could make their own asset allocations to very low-cost passive products that mirror specific indices. What you can see on this slide is that the most popular products for our participants have been the Vanguard Developed Markets Index Fund and the Vanguard Emerging Markets Fund. Together, those constitute almost half of Tier 2. And I can tell you that our participants have put around 9% of their funds into Tier 2 products to date. So that's what's happened with our performance. It's been a very strong performance for the first 3 quarters of the year. I'm now going to turn it over to Chris Moore of Summit Strategies, and he and I will talk about the outlook for the markets for 2018.
Great, thanks, David. So on this page, you can definitely tell these are some key things or key questions that very well might drive performance of the markets in 2018. The first of which is obviously the current administration and what, if any, impact their proposed policy will have on the market. Currently, as you had mentioned, the potential tax reform is being discussed and debated, and with the ultimate winners and losers being depending upon what the ultimate resolution, if any, gets passed. The next key question is what's the impact of central banks? So how much and how quickly, if at all, central banks continue to raise rates, and how that follows to the market will obviously also dictate both the fixed income market as well as quite possibly the equity market. Lastly, it's always a consideration, but geopolitical risk as the President Trump is in Asia today. What, if any, the resolution or what, if any, impact North Korea and or other kind of more volatile regions have on the markets? We'll obviously wait and see. But the other thing that we would continue to highlight is that the market is obviously pricing in expectations. And so what ultimate performance will dictate is depending upon how the surprises versus these base case expectations. As an example, in tax policy, the market has already expects some tax relief. So depending upon if there's more or less will ultimately drive market performance.
Right. Are you saying, Chris, that we may not make 17% next year?
No, I think that the strong performance has been great and welcomed, but is probably not the base case expectation of how we think about what more sustainable returns are over the longer term horizon.
So I know tax reform is very much on everybody's mind, and the resolution is before Congress, but it's very much a moving target at this point, isn't it?
Yeah, definitely. As well as it's very much a mixed bag. Here on the page kind of highlights some of the kind of current proposals at a broad brush level. Individuals, there's a kind of mix of decreasing tax rates versus basically funded from offsetting elimination of deductions. For corporations, also meaningfully impactful is reducing the marginal rate as well as allowing some of these foreign countries to repatriate some of these offshore profits or some of the key components. But of note is that these are both, the intent is for these, or the expectation both of these are depending on final conclusions, but will add to the deficit somewhere in the trillion plus range.
That's a lot of money.
It is. It turns out, and this has been the challenge for tax reform, is that a lot of these deductions are very well held, and to cut rates, you have to come up with offsetting revenue to kind of fund those decreases in tax cuts.
Chris, since the Great Recession of 08-09, we've seen very much below trend growth not only the United States, but really all over the world. What would be the impact of $1 trillion or $1.5 trillion extra dollars in the economy?
So the thought is that that kind of additional fiscal spending would be a little bit more of a tailwind for some of the global economies, U.S. in particular. But on the flip side of that, also very well might be a little bit of a catalyst for potential inflation as well.
Right. So I see that on this slide, you're projecting growth for the U.S. economy really in sort of the 2 to 2.5% range, and maybe even a little bit less than that.
Yeah, unfortunately, this is more the new normal. The expectation, the ability to grow dramatically is lower today than it has been, often the function of demographics as much as anything.
Whereas in the emerging economy, the growth might be more than twice that much.
True, is that because of some of the aging of the developed world, the ability to grow is much lower, but in the emerging economies, they are not as impacted.
Right, and I guess one of the questions that's on everybody's mind, we've become used to very low interest rates over the last 10 years or so. If there's going to be $1 trillion or $1.5 trillion increase in the deficit, should we expect inflation?
So that's obviously one of the big outstanding questions that the marketplace is trying to digest. So as you can see here, the unemployment rate has continued to decline back to kind of historical low levels, but we have not seen the commensurate increase in inflation. So this conundrum a little bit for both the market and policymakers is questioning if something has structurally changed or if perhaps we just haven't seen it yet.
That green line, the 10-year real yield, that's the yield on 10-year Treasury bonds that's above the rate of inflation?
Yes, that's the extra compensation that you're getting from current fixed income above and beyond inflation.
It's kind of almost zero.
It is. You can see from left to right, it's gone almost to zero. Part of this is that central banks have decreased this in an attempt to kind of heal some of the challenges of the great financial crisis, but also some of these kind of longer tenured things, demographics and so on and so forth, have weighed on it as well.
But if I look at that green line over 20 years, 20 years ago, you were getting a real return of about 4% on bonds. 4% over inflation. Now you're getting 0.5% over inflation. Is there any point in owning bonds?
So the role for bonds are a few things. One is you want to, in addition to income, is that it's a volatility dampener for the broader portfolio.
Like a shock absorber.
A shock absorber, if you will. And it still provides that role. The difference in today's fixed income environment is you're not garnering a lot of extra yield despite some of that insurance-like profile.
So one thing that a lot of people have talked about, of course, is that with the stock market going up steadily since 2009, 8 years in a row, has it gone too far? Are stocks overpriced? So I'm looking at this blue line on this graph, which is called the S&P earnings yield. The earnings yield is like the inverse of the price-earnings ratio. It's how much a stock is returning to a shareholder on an annual basis. In this case, 4.7%.
Correct. So you can see that post-financial crisis, it steadily marched down, and this is the rise of valuations. However, the red line here is showing again the kind of versus fixed income. The spread between those two is still very large, or is normal versus kind of its other experience.
So that's called the equity risk premium, because that's the bonus you get for taking the risk of buying stocks. In this case, about 4.4%.
Correct. So you can see that 4 and change percent on an absolute basis is low for stocks, but that premium relative to bonds is more in line to even wider than historical.
In other words, the gap between the blue line and the red line is wider than normal.
Correct.
So that would argue that unless the real return on bonds started to go up pretty rapidly, stocks aren't necessarily that overvalued.
Correct. That's another outstanding question is, even though stocks appear to be very rich versus their historical average versus themselves, on a relative basis, they seem to still be very compelling.
So I guess the other question that everybody asks is, how long can this go on?
So what has been unique is the notion of a business cycle. So most market and business cycles, on average, are approximately 5 years. You can see that in the chart here, saying this 25 quarters, 5 to 6 years is your normal kind of market cycle. We've lived in a relatively extended cycle, and as noted here by the 39 months. So from prior peak, we're going almost 10 years of this market cycle. So markets don't necessarily have a direct into them, but it has been very long in calendar quarters, this particular cycle.
So if I'm looking at this chart correctly, the longest cycle was 42 quarters?
Correct, in the 90s, which is somewhat feel somewhat similar to the environment we've been in recently.
Yeah, some people would say, Chris, and I've heard this said, that economic cycles are dead, that central bankers and the tools they have now at their disposal, coupled with this new low rate of growth because of the kind of older demographics in the developed world, have made the boom and bust cycle obsolete. What do you think about that?
I think that's a challenge to believe. I think that
wishful
thinking perhaps, as well as I think that sentiment also existed in the mid-90s before the great financial crisis, and we all know how that ended up.
Well, in fact, we had two in the 2000s, didn't we? Not only, of course, the recent one, 2008, 2009, but also the so-called tech bubble bursting around 2000, 2001.
Exactly.
So, as smart as central bankers are, maybe they haven't managed to get us out of the inevitable cyclical fate.
True. The challenge is that the market's made up by individuals who kind of don't always behave as their central bank models would.
Yeah. So one of the things I guess that you would expect to see, if we were, if the end was near, is you'd start to see markets jumping around more. Wouldn't you start to see some sort of increase in market volatility?
You would. And so going back to the challenge of where are we at in the cycle, we have meaningfully not seen that. This is kind of an representative example of what kind of price swings that the equity market, particularly the S&P, have seen. And we're kind of off the charts in that we haven't seen much of any down moves in the market.
So if I'm reading this correctly, over the course of the last 30 years, 20% of all trading days have seen the market move more than 1.5% a day.
Correct.
And this year, 1% of trading days.
Yes, we basically haven't seen much of any volatility this year.
And as you say, that's off the chart low.
Correct.
So does that mean we should have confidence that nothing bad is going to happen?
No, it's just that normal volatility very well might return and isn't in and of itself a cause for concern.
I can certainly see, if you look at 2005, 6, and 7, when volatility was very low as well, and then you see what happened in the period 2007 to 2010, the potential for it to come back is certainly there.
Definitely. The challenge, again, is in a 2005 environment, we saw somewhat similar things, so it can still extend for multi-year periods.
Right. Okay. So I guess the question for our participants is, given all this stuff, what is our expectation for the various asset classes that they have open to them for investment?
So I think that there's a couple things of note. Is equities are more not in line with recent equity performance, but perhaps towards the lower end of historical norms are our expectations. What you can see here is that the equity market has, over long periods of time, been compensated. So the annualized return here is at a 7.5% rate over the multi-decade period. However, you can see very rarely are you on that 7.5% line.
So the red line is a trend line. If I put all my money in the S&P in 1997 and then went off to a voyage to Mars for 20 years and came back, I would have made 7.5% a year.
True, including some of those large corrections.
Even through 2 complete market cycles.
Definitely.
But on the other hand, if I had stayed here on Earth and lived with the market from a day-to-day basis, I would have experienced the black line rather than the red line.
Correct. So it just goes to show that the longer you extend your horizons, the more realistic these return expectations are.
Right, and it also shows you the futility of trying to time the market, because who knew in 2000 that we were about to have 4 years of negative returns?
True.
Who knew in 2009 at the bottom of the market that we were about to have 8 years of straight up returns? Definitely.
It's often when the markets are calm, is not necessarily in people are maybe more fear and greed cycle, more greedy, is the opposite in 2009. In hindsight, even though it was a very fearful time in the market, you are well compensated over the longer horizon.
So what can our participants do to try and smooth out the bumps?
And so there are a few things that we can do to smooth out the bumps, one of which is be more realistic in your expectations. And in general, extend your investment horizon. The smoothness often happens the longer that you look at it. Year to year, day to day, the market's going to do what it's going to do. A lot of the smoothing is how you approach the investment horizon for these returns.
So Chris, when I started in this business, more years than I want to talk about, we thought that retirees at 65 had a pretty short investing horizon in front of them. That's no longer the case, is it?
No, definitely not. And even folks who are in their 60s at this point in time have a multi-decade horizon, perhaps.
Maybe 25 years.
Exactly.
So what's the danger there if they get too conservative?
The danger is of being too conservative, especially over 10, 20, and 30 years, is ultimately running out of money, which is a real risk as well.
Right. So, for example, if a 65-year-old said, "Look, I'm retired now. I have no more income. I should put all my money into bonds and get 3% or 2% instead of whatever we're getting in the stock market." That could be a problem.
Definitely, especially when you consider over these long decade-plus horizons, stocks in and of themselves aren't near as risky.
Okay, so really, and of course, there's also the effect of asset class diversification that we talked about at the very start, isn't there?
Yes. So despite some of the challenges and strong equity performance, particularly in the U.S., there are other pockets of value that are represented in the portfolio as well.
Not necessarily all correlated. In other words,
true.
They don't always move in the same direction at the same time.
True. Diversification is still one of the free lunches available in the market.
Right. Okay. Thanks very much, Michael. I think that's what we have to say.
Thank you very much, David and Chris. That was an interesting conversation about where things may be headed into next year and beyond. Before we turn it over to the Q&A, I want to apologize for the audio issues we were having at the outset of the webinar. I think you missed everything I said and everything that Len said, so I'll just repeat a couple of things. First, the webinar is being recorded, so you can view it at your leisure once it's posted on our website. I also mentioned and want to acknowledge the passing of Paul Rockfeld, who is the RPB's former Chief Financial Officer. Paul worked for the RPB for 18 years and was also worked for the movement for quite a bit longer than that. He was a tremendous person and will be surely be missed amongst all of us. And so with that, I wanted to turn it back to Len for a second time, so he can just repeat a couple of things he mentioned, and then we'll allow for some time. We have plenty of time for Q&A, which, by the way, if you have those questions, can be submitted by clicking on the Q&A button on the top right of your screen.
Let me be very quick and just touch on a few points. Number one, in the first quarter of 2018, we expect to unveil some further exciting enhancements to the retirement plan. We intend to issue a loan program as an alternative to a hardship withdrawal. This is in concert with with our tax laws and provisos. It'll be a non-taxable withdrawal, but must be paid back. Details will be forthcoming and described to you in full during the first quarter. Also, we plan to offer a Roth 403B plan. These two items, the loan program and the Roth 403B plan, we think are something that you can make good, judicious use of, and by all means, feel free to be watching your emails, if you will, as well as postings to get further detail. But I'm particularly excited to say we've just finished an investment committee meeting where the next step in the formulation of the groundbreaking Reformed Jewish Values investment portfolio as a Tier 2 investment choice is now over. Reform Movement will be the groundbreaker to offer this initiative, and while others have discussed this concept, your board has accomplished this objective. We owe grateful indebtedness to Michael and his team for bringing this to fruition. I and others have been working on this for almost a decade, but enough discussion, let's get it done, and your staff and board were incredibly instrumental in making this a reality. Again, we're hoping first quarter of 2018. Information is key. For those of you who have spoken to Robert Perry, your Director of Participant in Employee Services, know what a resource he is. We encourage you to use our staff facilities to help you make and be currently informed as to what's going on. I want to stop there and get to the Q&A. There's no question that these webinars and what you've seen as a different view to our communications strategy and marketing is all under the direction of Stephanie Berger, your Director of Marketing and Communications. We're trying to emphasize this is not your Zeta's RPB, and we think that this goes a long way to establishing who we are now and where we've come from. There's no question at all that you have a staff that has your best interests at heart and continues to work hard to earn your trust. Let me stop there and get to Q&A, please.
Thank you, Len. So again, if you have any questions, please submit them by clicking on the Q&A button, and we'll try to address them. Right now, we just have a couple that have come in. The first question, and I'm going to ask David and Chris to maybe address this, is as follows. Can you speak to asset allocation based on whether you are still working versus retired? In concrete terms, how much risk is appropriate?
So I think that's one of the key questions for our participants. In general, I think probably most practitioners would say that working people can afford to take greater risk simply because they have more income coming in to replace assets that might be lost in the event of a big market correction, for example. But at the same time, it's now recognized, I think as we said earlier, that one's non-working life might extend almost as long as one's working life, and that therefore being too conservative too soon or too early could be a mistake. So my take on this in my practice is that generally we do modify our portfolio risk somewhat when people have retired, but not as radically as we used to, say, 20 years ago.
Yeah, I think I would add marginally to that is individuals have their own risk tolerances as well. So in addition to the investment horizon, kind of the personal preference of how much is an appropriate risk varies person to person as well, would be one other kind of consideration for a broad recommendation.
Yeah, and I guess the last thing we would say is that every family is different, and one might have a working spouse or a non-working spouse. One might have other assets outside of the RPB plan, and that's why we encourage everybody to seek counseling and make a decision based on all the factors rather than just one.
Thank you, David and Chris. So we have one more question that has come in, and I'll ask Len to answer. Any predictions about what might happen to parsonage if the new tax code is adopted?
As of now, we've seen nothing in the new tax code that would affect parsonage per se. The genesis of this question may have been that there was a headline that the courts were taking up the question of parsonage again, at least starting to. We have posted our current thinking on our website a few weeks ago and have been in constant touch with our outside counsel. Their opinion was that any impact, if at all, will be in the distant future. In fact, some have suggested years from now. So we see nothing in the tax code yet. Of course, it had nothing, but when it came from the court decision on parsonage, our counsel, again, to repeat for emphasis, sees nothing that we should be concerned about in the near future. I don't know if that answers your question completely, but basically nothing now.
I might add to that, Len, if I may, that while a decision came down at the district court level, this is going to go through the appeals process, which is going to take years and likely go to the Supreme Court. But we're monitoring, as Len said, very closely. I know the CCAR is also monitoring the parsonage case as well. As far as the tax legislation is concerned, we're also monitoring the tax legislation for impact on the RPB and its participants. And I think it's probably a little too early to predict where that's going to land, given the horse trading that will likely happen over the next however long before tax legislation is passed. So it's going to be some time. But again, as things progress, as we learn new facts about the legislation, we'll keep everybody informed about any potential impact. Let's see, any other questions? Seeing no other questions, I guess we can conclude by thanking again everybody for joining us today. Again, apologies for the audio issues we're having earlier, and stay tuned for the next installment in the early spring of our webinar series, as well as information about all the additional enhancements to come in 2018. So thank you, and have a great rest of your day. Oh, sorry. A late breaking question before we sign off. So, question. I think this is a David and Chris question. When shown the chart regarding quarterly growth, why should we expect that it will go further than 42 quarters? So that might have been the cycle, the growth cycle chart.
I think the answer to that is that every economic cycle is distinct unto itself. The underlying economic conditions are, in every case, unique, and it's very difficult to tell what's going to happen next. So clearly, we're already on the thin side of the distribution curve in terms of how long this cycle has lasted. But I can say that a lot of people sold stocks in 2012 because they'd gone up 4 years in a row, or 2013 or 2014 and 2015. And the cost of getting out of the market too early is very difficult to make up if you miss out, for example, on a year such as we've had to date this year.
Yeah, I would just add that, you know, history rhymes, and that this is definitely a bit of a different cycle as well. So although the length has been very, very long as far as the cycle, the magnitude has been a little disappointing versus historical norms. So to some extent, that might be a catalyst for it even more extended this go round.
Great. Well, again, thank you, David and Chris. That was a good answer. Seeing no additional questions, I think we'll conclude today's webinar. If you do have follow-up questions, you can always email them into pensionboard@rpb.org, and we will try to address them on future calls. So again, thank you very much. Have a great day.
Bye-bye.